Baidu is one of China's most popular tech companies, essentially the equivalent of Google in the US. Baidu has had a rough time in 2021 and a rough start in 2022. So let's take a look at that, see where the company and the stock is right now, and also talk about where the stock price may go in 2022. Ready? Let's get started. Baidu is the biggest search engine in China with a 80.14% overall search engine market share and 93.37% of the mobile search engine market share. Another part of Baidu's business is iQIYI, which is 100% Baidu owned. iQIYI is one of the biggest Chinese video platforms and also one of the biggest in the world. Baidu also owns Baidu Cloud and is a global leader in AI, AR and VR tech. In fact, Baidu is in third place globally in terms of VR and AR patents in the last 2 years with 3,094. It's ahead of companies like Facebook, Google and Microsoft, so that counts for something. Overall, these are the main drivers of Baidu's business, with revenue from online advertising being the biggest chunk at 65%, followed by iQIYI at 24.5%, then the Baidu Cloud at 12.1%. However, Baidu is also involved in a number of other initiatives like their smart vehicles partnership with Geely, the Apollo autonomous taxis, and more. Actually, Apollo's autonomous driving tech is now being used by BYD, which is backed by Warren Buffett, and that looks like a good sign for me. Still, the most profitable part of their business is the core offering of online advertising and cloud services, which has a net profit of $2.17 billion out of a total revenue of $14.9 billion for a net profit margin of 14.5%. Even though iQIYI is a big revenue driver, the business unit is actually losing money. iQIYI made a loss of $0.96 billion on a revenue of $4.8 billion. By the way, these figures are taken from their latest annual report, which is released on 28th of March, and you can find the link for that in the description below. The main trend that we can see here is that Baidu's online advertising and iQIYI are stagnating a bit, which is not great. However, their cloud and other initiatives are growing fast. In fact, Baidu's cloud is expanding rapidly and grew 44% between 2019 and 2020 and 64% between 2020 and 2021, making a total revenue of $2.36 billion in 2021. Overall, Baidu is doing okay, it's profitable, it has stable operations, but it probably needs to rethink how iQIYI fits with its core business. Apart from stable operations, Baidu also has healthy finances. Baidu has a net cash position, meaning that it has more cash and cash equivalents than long-term debt. What's important here is that their net cash position is huge. Baidu has a market cap of $43.8 billion, but they have net cash worth $15.2 billion, or about 35% of their market cap. Basically, the market is valuing Baidu's business at only $28.6 billion, which makes a big difference. That means a PE ratio of only 18.4 and a forward PE of 10.49 for 2022, which is an incredibly low price to pay for a search engine market leader and a global leader in AI, AR and VR. However, price isn't really Baidu's problem. It's legislation, it's regulation, both in China and in the US. Now, it's important to point out something here. When you are buying Baidu, what are you actually buying? The Chinese company headquartered in Beijing? No. You are buying Baidu Incorporated, a Cayman Islands holding company. You can see that in their annual report under key information. While it does look incredibly suspicious, there is a reason behind that. Chinese laws prohibit foreign investment in internet content, online marketing, audio, video services, etc. So this is basically the workaround that most Chinese companies have in place. That's the reason why the SEC targeted Chinese companies over the last 2 years and issued the Holding Foreign Companies Accountable Act in December 2020. Under this act, the SEC can delist foreign companies which fail to comply with the transparent accounting standards that have been set out in the act. That basically includes using a legitimate auditor which can be inspected and investigated by the Public Company Accounting Oversight Board, or PCAOB. What I personally find worrying is that Baidu was actually called out by the SEC for its latest annual report for not having used such a legitimate auditor. Baidu have a deadline by the 20th of April to dispute that, but by the looks of it, Baidu is not really doing that. This is not the end of the world for Baidu, as they cannot be delisted until the company has been identified by the SEC for 3 consecutive years. However, it does point out some issues around transparency, integrity, and so on. The fact that the auditor cannot be inspected means that all of the figures reported in the annual report may be misleading. That's why I think Baidu is currently trading with a massive risk premium, and despite its relatively low valuation, the stock is not really going anywhere. Stock price is typically driven by the big players, institutions and large hedge funds buying in. The fact that Baidu's reporting could be inaccurate means that a lot of those big players will likely avoid the stock. The added chance of getting delisted doesn't help either, even though there is still a lot of time for Baidu to avoid that. However, Chinese regulation also hasn't helped Baidu's case, with regulation around data management and so on. There haven't really been a lot of developments since I last covered the situation back in November and August, although Chinese regulators have started approving video games again, and Baidu has actually had one of their games approved. Bang Bang Rabbit is the name of the game. Even though that's good news, Baidu's gaming department is really small and doesn't contribute much to their overall revenue and profits. So, what stock price movement can we expect from Baidu? Honestly, I don't know. Baidu is currently trading below its 10, 50, 100 and 200 day simple averages. It is down 15% for the year. Baidu went through a correction, through a bear market, and is now deep in the crash territory, with its stock price down 65% from its all-time high in February of last year. My best guess is that it will continue to trade between $107 and $160, with $107 being the more likely option. To me, it looks like there is a strong resistance at about $136, so I will be watching that. Still, Baidu stock and really most Chinese stocks listed on the US stock exchanges have been extremely volatile, so it's a bit hard to guess what can happen next. What else should we be watching as retail investors? Like I said, the main factors keeping Baidu's price down are legislative. Keep an eye on Baidu's press updates on their website, keep an eye on what the SEC says about Chinese companies, and keep an eye on Chinese legislation. I think this will move the price up way more than any surprise earnings. However, I also think that we need to manage our expectations. The Chinese government has shocked investors on a lot of occasions over the last few years, so it's likely that institutions and funds will avoid China over the next few years until things settle down a bit. Personally, I have stopped investing in individual Chinese stocks and instead I've picked up some emerging markets index funds that target China. I'll probably get lower returns if and when the Chinese market starts going back up again, but at least I'm relatively protected in terms of risk. The general advice seems to be to invest in broad index funds when you're not familiar with the market, so I'm doing that. After all, even Charlie Munger took massive losses investing in Alibaba, so I think being cautious when it comes to China is a very smart thing to do. That's all I have to say when it comes down to Baidu. What do you think? Are you bullish or bearish? If you enjoyed the video, please leave a like and share with friends, it really helps the channel. If you like this type of content, make sure you subscribe and join the Newbie Investors family. Thanks for watching and I'll talk to you again soon.